The world thinks the next financial crisis will begin in the stock market. It won't. The next crisis will begin in the bond market, quietly, invisibly, and most people won't even realize it's happening until their mortgage payment jumps, their retirement account crashes, and governments around the world start panicking behind closed doors. Because while everybody is distracted by wars, elections, inflation, and oil prices, something much bigger is happening underneath the global economy. The countries that once financed America's debt are starting to pull away, and the United States is being forced into a corner it has never faced before. 2 weeks ago, I told you that America was fighting 2 wars at the same time. One war everybody can see on television, and another war nobody sees because it's happening inside the financial system itself. Now, over the last few days, that invisible war escalated dramatically. Multiple foreign governments have quietly approached Washington asking for emergency dollar support, and stripped of the diplomatic language, their message was simple. If you do not help us raise dollars, we will have no choice but to dump US Treasuries onto the open market, and if that happens, your bond market breaks. Now, before we go further, you need to understand why this matters so much, because most people hear terms like Treasury yields or bond markets and immediately tune out. But the Treasury market is not some boring corner of Wall Street. It is the foundation underneath the entire global economy. Every mortgage rate, every business loan, every government budget, every pension fund, every banking system on Earth is connected directly or indirectly to the price of US government debt. If the Treasury market becomes unstable, everything becomes unstable. For decades, the system worked perfectly. The United States spent more money than it collected in taxes every year, and to finance that gap, it borrowed money by selling Treasury bonds. Countries around the world bought those bonds because they were considered the safest assets on Earth. Japan bought them, China bought them, Europe bought them, oil exporting nations bought them. Everyone trusted the United States government would always pay its debts, so the system became self-reinforcing. America got cheap borrowing costs, and foreign countries got a safe place to park their reserves. But the entire system depended on one critical assumption, that foreign countries would always continue buying and holding treasuries no matter what happened. And today, that assumption is starting to break apart, because the world is running short on dollars at the exact same moment. Countries need dollars the most. Energy markets are unstable. Shipping routes are under pressure. Oil prices are volatile. Insurance costs are exploding. Governments around the world suddenly need enormous amounts of cash just to keep fuel, food, and critical imports flowing into their economies. And when countries need dollars urgently, they are forced to sell assets to raise that cash. Now let me ask you a simple question. If you were a foreign central bank and needed billions of dollars immediately, what asset would you sell first? You would sell the most liquid dollar-denominated asset you own, US Treasuries. And that is exactly what is beginning to happen. This is the part most investors still do not understand. Countries are not selling Treasuries because they suddenly hate America. They are selling because they need liquidity. There is a massive difference between being broke and being short on cash flow. A country can still be enormously wealthy while simultaneously running out of immediately available dollars, and that distinction matters because some of the richest nations on Earth are now facing liquidity stress. Now let me explain why this becomes dangerous for the United States itself. Imagine I loan you $1,000 for 10 years at 4% interest. Every year, you pay me interest, and at the end of the 10 years, you repay the full amount. Sounds simple enough, but now imagine 3 years later, I suddenly need my money back immediately. The problem is you don't owe me repayment yet, so I have to sell that loan to somebody else. Now the person buying that loan knows I'm desperate. They know I need cash today, so instead of paying me the full $1,000 value, they offer me only $800. I accept because immediate cash matters more than waiting years for full repayment. Now think about what just happened. The new beer paid less money but still receives the same interest payments and eventual repayment value. That means their effective return, or yield, is now much higher. That is exactly how the Treasury market works. When countries become desperate for dollars and start selling Treasuries aggressively, bond prices fall and yields rise. And when Treasury yields rise, borrowing costs across the entire economy rise with them. Mortgages get more expensive, car loans get more expensive, business financing becomes more expensive, government debt becomes more expensive. Everything tightens all at once, and this creates an impossible trap for the United States government, because America itself still needs to borrow enormous amounts of money every single year. The government spends trillions more than it collects in taxes, so it constantly needs new buyers for its debt. But if existing Treasury bonds are suddenly trading cheaper on the open market, why would investors pay full price for newly issued government debt? They wouldn't, which means Washington is forced to offer even higher interest rates just to attract lenders, and that is where the debt spiral begins. The more interest rates rise, the more expensive it becomes for the US government to finance itself, and the more expensive debt becomes, the larger deficits grow. Then the government must issue more debt to cover those higher interest payments, which then pushes borrowing costs even higher again. It becomes a self-feeding cycle. Now, policymakers understand this danger very clearly, which is why something extraordinary is beginning to happen behind the scenes. Countries short on dollars are approaching the Federal Reserve asking for emergency liquidity facilities, known as swap lines. Now, swap lines sound technical and boring, but they are one of the most important financial tools in the world. Here's how they work. The Federal Reserve creates dollars electronically and lends those dollars directly to foreign central banks. In return, those countries temporarily pledge their own currency as collateral. Then later, in theory, the dollars get repaid with interest and the transaction unwinds. Now officially, these swap lines are presented as temporary emergency support measures, but in reality, they serve another purpose entirely. They prevent foreign governments from becoming forced sellers of US Treasuries during periods of dollar stress. Because think about the alternative. If countries cannot access emergency dollar liquidity, they must raise cash themselves. And the fastest way to do that is by selling Treasury bonds. But if multiple countries start selling at the same time, bond prices collapse, yields surge higher, and the entire US financial system comes under pressure. So when the Federal Reserve opens swap lines, it is not simply rescuing foreign countries, it is protecting the Treasury market itself. And here's where things become even more interesting. During the 2008 financial crisis, swap lines were treated as extraordinary temporary measures. Then during the pandemic crisis in 2020, they returned again. But after those crises ended, something changed quietly in the background. Several of those temporary facilities became permanent standing arrangements, and once emergency measures become permanent policy, the entire financial system changes, because now markets begin operating under the assumption that central banks will always step in during crises. Risk never truly disappears. It simply gets transferred higher up the chain until eventually sovereign governments themselves become responsible for absorbing instability. That is the position the Federal Reserve is increasingly moving toward today. It is no longer merely acting as lender of last resort for American banks. It is becoming the lender of last resort for the global dollar system itself. Now think about the scale of that responsibility. The entire world depends on dollars for trade, energy purchases, debt payments, commodity settlements, and international finance. So when dollar shortages emerge globally, every country scrambles for the same thing at the exact same time. And that pressure ultimately lands on the Federal Reserve. But there's a problem. Creating more emergency dollar liquidity stabilizes markets temporarily, but it creates long-term consequences too, because the more aggressively central banks intervene, the more confidence investors begin losing in fiat currencies themselves. And that is one reason gold prices have been climbing so aggressively. Central banks around the world are buying gold at the fastest pace in decades because they Understand something important. The modern financial system is becoming increasingly unstable underneath the surface. Now, none of this means the United States collapses tomorrow. America still possesses enormous advantages. It has the largest economy on earth, the strongest military, the deepest capital markets, and the dominant reserve currency. But even powerful systems eventually run into mathematical limits, and the amount of debt now embedded inside the global economy is unlike anything we have ever seen before. This is why every treasury auction matters now. This is why every move in bond yields matters. This is why foreign central bank reserve data matters. Because the treasury market is no longer just another financial market. It has become the pressure point holding together the entire global system. And over the next year, I believe we are going to see several things happen simultaneously. More countries will quietly request emergency dollar facilities. More swap lines will become permanent. More treasury market intervention will occur behind the scenes. And governments around the world will increasingly realize that the old financial system cannot survive indefinitely without constant support. Now maybe policymakers manage to stabilize everything gradually. Maybe energy markets calm down. Maybe liquidity pressures ease. That is possible. But if they don't, then the world is heading into a completely different financial era. An era of higher volatility, higher inflation, larger government intervention, and permanent financial repression. Because once debt levels become too large to repay honestly, governments usually choose another path. They suppress interest rates artificially. They allow inflation to slowly erode debt burdens over time. And they force savers to absorb the cost quietly through declining purchasing power. That is why understanding this moment matters so much. Because most people still think we are living through a temporary economic cycle. I don't think this is temporary anymore. I think we are watching the early stages of a structural shift in the global financial system itself. And the scary part is that most of it is happening quietly, behind closed doors, while the public remains focused on headlines that barely scratch the surface of what's really going on. Because the visible crisis makes the news, but the invisible crisis changes the world.